Hi everyone, welcome and thank you for joining us for today's webinar. My name is Mary Jane and I handle event and marketing at Singapore FinTech Association. Today we will be presenting the first webinar of 2022 titled Bringing Digital Assets and Crypto to Your Customers, an Introduction, presented by Matthew, Stephen and Saga from Fireblocks. Just a little housekeeping before we get started. If you have any questions during the presentation, please type them into the question box in your Zoom control panel. It will be brought up during the presentation and we will also have time for Q&A at the end. Now, without further ado, we will turn the time over to Matthew, the APAC Director of Marketing of Fireblocks. Matthew, please.
Thank you, MJ. This will actually be the first of a webinar series of 3 that we'll be conducting in relation to crypto digital assets with Singapore FinTech Association and FinTech Association of Hong Kong. There has been a lot of talk and interest that we hear from the member community about crypto and digital assets. So, it is the very intent of this webinar and this series to share, more insights about the current trends supporting technologies and key considerations when you are thinking about your initiatives in your journey to adopt and manage your crypto and digital assets. We really hope that the webinar will provide you a better understanding of how you can take on this digital asset and crypto journey to better serve your customers while mitigating risk and to drive greater success. So without any further ado, I'd like to hand over to both Stephen Richardson, our head of APAC, VP of Product Strategy and Business Solutions from Fireblocks, and Saga Sabai, who's actually our Director of Business Development at Fireblocks. So Stephen and Saga, please take it away. Thank you.
Yeah, very nice to meet everyone today. Looking forward to this panel and this session on really how you can move your digital asset journey forward. As we go into the agenda for today, would really like to focus on a few key areas that we think are fundamentally important as people start their digital asset journey. The first being, what is the landscape around digital assets today? And how's it changing? What are the macroeconomic factors that we're seeing in the space that have made digital assets more intriguing for businesses, into 2022 and moving forward towards 2023? I think the second thing we want to think about, how has the digital asset landscape evolved? And what does it look like as people and traditional institutions really start to engage in the space? We'll then go through the broader market segmentation and the use cases around digital assets, and then really critically around the broader infrastructure that folks need to be able to engage in digital assets overall. So we think about 2 key critical components, the idea of self-custody of digital assets and that of sub-custody. We'll explore that a little bit more deeply and really explain the differences between those 2 models as you think about your day one go-to-market approach. And then we'll go into the go-to-market approach as we see it today. And as we've worked with a number of institutional clients as they've entered into this space, we've thought around a high-level framework that folks will be able to utilize as they think about engaging in the digital asset journey. And so what we'll do is just really go through these components today and make sure that we give folks a good understanding of, what does it take to enter this space? What are the key concerns and areas to be aware of? And how do you navigate this journey effectively? Now, as we think about the digital asset landscape, I think what we'd like to point out is there's been a lot of news in the media around digital assets, right? From the likes of JP Morgan and DBS, starting and Temasek starting a company, Partior, around blockchain-based payments. We've seen PayPal emerge and come into this space. Recently announced some news around a stablecoin issuance. BNY Mellon, that's a client of Fireblocks, one of the largest global custodians in the world, pushing towards a digital asset offering. To Square and just a number of other institutions that have entered into digital asset space. We've seen more of an emergence for both the traditional finance, but as well as the FinTech and retail B2C players enter the digital asset space. And we think that this is something that's going to continue to move forward or be pushed forward in 2022 as we're starting this year off. Now, one of the ways to really think about, why this is occurring in the space and why we're seeing such a shift towards digital markets can be done with the framework of a pestle analysis, really thinking about what are the different components from a holistic level that are pushing institutions towards digital assets. I think you first think about the political landscape, right? Are you seeing more of a favorable political outlook towards digital assets? Whether you see that in Europe with places like FINMA, BaFin in Germany, MAS and what they've done here in Singapore, and even in the US, during the previous administration, and still a lot of attention in this current administration, you're seeing more of a favorable outlook and kind of broader structuring towards digital assets. I think at an economic level, right, you're seeing a really strong devaluation of fiat currency, especially around this COVID timeframe and a bit more of the inflationary aspects that are happening across different regulatory environments or zones. And so you're seeing more of a push towards an asset alternative that can offer increased yield and diversify portfolios. From a social perspective, we're seeing this new demand towards Web 3.0 and the ability for folks to really own their own data, to profit from their own data, to create new experiences. And that's been something that we've seen with the likes of NFTs, newly done in gaming. And there's a range of different aspects where you're seeing, a large retail base really start to demand a new change in terms of how they interact with information disseminated on the web. I think from a technological perspective, you're seeing a ton of innovation in the space. And I think that's one of the things that's so exciting about digital assets is the kind of the pace at which innovation occurs. You're seeing a ton of innovation in areas like non-fungible tokens, from things like music to art to gaming. You're seeing a shift towards Web 3.0 and the broader experiences around things like the metaverse. And then you're seeing this growth of decentralized finance, this idea of exposing financial products to the retail segment in a highly distributed way, kind of getting rid of this central intermediary and allowing folks to be able to gain access to yield directly. Now, from an environmental perspective, we're seeing a lot more innovation around the type of protocols that exist in the space that really reduce some of the concerns around the environmental impact and carbon footprint. So, a lot of the concern in the space was around things like Bitcoin and the amount of energy that it takes to mine transactions. But we're seeing a big shift towards more environmentally sustainable blockchains, right? And the ability for the utilization of digital assets to happen in an environmentally friendly way. And then the last thing is from a legal perspective, right? It's the regulation clarity that's happening in the space. And I think some of the great jurisdictions to look at are those in Europe, right? With FINMA in Switzerland and BaFin in Germany. But this idea of MiCA that's coming across probably in the next 2 to 3 years that will provide some level of homogeneity in Europe around digital assets and how folks should be able to engage in that. In places like Singapore with the DPT license, you're seeing, again, greater clarity in how folks will be able to interact with digital assets, which then give financial institutions and retail companies a bit more certainty as they look to enter into the space. So all of these things from, I'd say a high level perspective are what we're seeing folks now start to push towards new products and services in the digital asset space. Now, as we think about the broader evolution around digital assets, I think there are a few things to be very keenly aware of. The first is, digital assets are fundamentally different than, traditional assets, right? In terms of a ton of the different mechanisms that are used to engage. First and foremost, it's a 24/7 operating market, right? There's no idea of a Monday to Friday opening hours and 9 a.m. to 3 p.m. close. Digital assets trade 24/7 uniformly across the globe with distributed pockets of liquidity, right? And the idea that basically this liquidity is highly fragmented is something that's very different than what we see in the traditional spaces where there's centralized clearing institutions or FMIs that really control access to the different types of assets that exist in the space. From a third perspective, we're seeing a ton of evolving use cases. And so there are new models, both from a financial and technological perspective, that are emerging in the digital asset space. And we see that pace of innovation be something that's fundamentally different than what we've been seeing in the traditional space for a long time. And we think, as more derivative products come out, as we see the utilization of Web 3.0, we'll continue to see more evolving use cases for both the retail segment as well for traditional finance. And then there's this constantly changing regulatory landscape. So, one can use, for example, India as a great example, right? There's been a ton of news, both positive and negative, and constantly changing around the idea of engaging in digital assets. And from jurisdiction to jurisdiction, we're seeing kind of this constantly evolving global regulatory landscape. Now, we do have a forward-looking thesis that we believe that regulation will start to smooth out concurrently across different jurisdictions. FATF regulations and other things will kind of play a key part in that. But this is still something to be heavily aware of as folks look to engage in the digital market, digital asset space. So I'm going to change my screen. Now, where do we think the market is going, and what's our view on the evolution of this marketplace and where we are? I think it's keen to, or important to really think about, what are the use cases that we're seeing in this space today? Where do we think the market is going in this 2 to 4 year horizon? And where do we see the market going in this 4 to 10 and this further looking horizon? I think as you look at the market today, a lot of it is around things like speculative trading of crypto native assets, right? You'll see the large centralized crypto exchanges, the idea of DeFi and yield generation through DeFi and CeFi markets. But this is done on traditionally native digital asset tokens. And here you'll see folks that are crypto native firms, some FinTechs, really start to really engage in this space, right? So the likes of Robinhood and Revolut, and Square and PayPal on the FinTech side, but you have large crypto native firms, large traders, market makers, and DeFi pool funds that basically are really, taking hold of this speculative trading part of the market. Now, today, where banks are is really along the lines of building infrastructure for digital asset custody and trading. And this digital asset infrastructure can be not only on the tokenized security side of the house, but also on the natively digital side. And we think that it's fundamentally important for banks to be able to build critical infrastructure that supports both of these use cases. As we then move towards this 2 to 4 year horizon, we really believe there's going to be more around decentralized capital markets. And this is going to happen in the crypto native segment. So we think that there's going to be an even bigger push towards DeFi and the utilization of things like regulated DeFi pools, as well as new kind of technological applications in the DeFi space, where the crypto native segment will really take hold and push the space forward. We think there's going to be a lot more tokenization of traditional assets, and that's something that we're seeing from large traditional institutions or financial institutions as they're evaluating digital assets and entering into the blockchain space. And we think there's going to be a lot more trading at the CeFi and DeFi level of tokenized assets that exist today at banks, right? And how those start to interplay and how these systems become more open will be something that will be a fundamental game changer, I think, in terms of how digital assets evolve. And then lastly, we think that more payments are going to be powered by stablecoins. So we're seeing the evolution and the kind of the introduction of stablecoins both in the US. We're starting to see more of an introduction of stablecoins in Europe and here in APAC. And we think that's going to provide a really unique mechanism for which payments start to get powered or are powered. And large institutions that were typically in the middle of this payments infrastructure, think about it as the Visas and MasterCards of the world, will start to be somewhat disintermediated in the medium to long term. And then further out, we see domestic cross-border payments as being a critical area to explore, as well as CBDCs for wholesale and retail. Now, we think that CBDCs will start at the wholesale level between banks, so bank to bank, really for the effective settlement of intrabank payments. And then eventually, we think, from our perspective, it will start to trickle down into retail via banks tokenizing commercial bank money. That will be a very interesting play for the space overall. And then a further push towards more decentralized trading and the disintermediation of financial market infrastructure, FMIs and CSDs. And so we think kind of this represents the best path forward, or kind of what we believe the path forward around digital assets will be in the short, medium, and long term. Now, what I'm going to do is pass it to Sagar, who will take you a little bit through the broader market segmentation and some of the use cases that we're seeing in the space today.
Thank you, Stephen. So Stephen obviously gave a very nice overview of what's happening on the macro front and what are the trends and the evolution. In the next couple of sections, we will talk about the specifics. We will zoom in. If you are, let's say, a big fund or a payments company or a neobank, how do you actually start your digital assets journey? How do you jump into things? How do you implement things? The next couple of sections, we're going to focus into the specifics. So let's start with the use cases and the market segmentation front. So we believe that if you are any institutional business or B2C business, there are multiple use cases that you can start on day one, but really for every use case, the foundation layer would typically will start with custody. Now, when we talk about custody, there are, of course, two models. One is that you can do a direct custody of your funds or your customers' funds, or you can outsource the custody to a dedicated sub-custodian. And we'll cover the differences in the next couple of sections, but really everything starts with custody as the foundation layer. And as you can see on this slide, once you have set up the custody layer, then you can enable multiple use cases. And as Stephen mentioned earlier, until now, the focus was more on the speculative trading side of things. But as the industry matures and evolves, we'll see a lot of very interesting use cases around tokenization, payments, and so on. So I think the easiest part, once you have set up the custody layer, the easiest part is that you can start, and once you have gathered the license, you can start offering custody services to your HNI customers or your institutional customers, and then charge a fee for that. You can then evolve and start offering simple buy and sell services. And again, you need not set up your own order book, but basically launch a brokerage model where you can piggyback onto a liquidity provider, add your spread, and then provide that front-end buy and sell use case to your customers. As you evolve into your journey, then you can start looking at more what we call exotic use cases. So for example, staking, where you allow your customers to pledge assets to various protocols and then start earning rewards and yield on in exchange. And really in the more mature markets with negative interest rates and low interest rates, that becomes a very attractive business offering. You can then look at lending services, where essentially you can start offering fiat in return for crypto as collateral, or vice versa. So companies like BlockFi and Celsius, they are enabling this, and I think we believe that over the next 3 or 4 years, this will become a very interesting use case for both the crypto native firms and the traditional firms. Of course, if you are a hedge fund or an alternate asset manager, you can look into prop trading, where you leverage your own balance sheet and then start looking at, let's say, for example, arbitrage opportunities and start generating revenues from that. And then last but not least, something which we are very excited about at Fireblocks is around tokenization. And as Stephen mentioned earlier, our thesis is that over the next 5 to 10 years, every asset class out there will become tokenized. And I think that becomes a very interesting move from a first mover's advantage, because then there's a lot of revenue to be generated in that on the tokenization front. So in the next slide, we'll try and give you some numbers around some of these use cases, just to give you an idea of the magnitude of the opportunity out there. So let's hypothetically assume that you are a mid-tier firm or a tier 2 bank, and you very conservative, you are able to have a $10 billion asset under custody. And again, just to give you a reference, Coinbase has around actually now close to $300 billion assets under custody. So 10 billion assets under custody is actually a very conservative figure. Now, as I said earlier, the easiest offering that you can provide is leverage your license. Let's say you are a firm headquartered in Singapore. You can apply for a DPT license and start offering custody services to, let's say, other institutional players. And then with a very simple bips, let's say a 10 bips charge, there is a lot of money to be made there. Similarly, you can start offering trading services. Let's say if you are a super app or a FinTech, you can start offering trading services, charge a very conservative 50 basis points to crypto trading, and assuming a 5x churn, you're looking at a potential $250 million opportunity just by offering a very simple agency trading or a brokerage model. Then we talked about lending. So let's say, again, companies like BlockFi, Celsius, etc. In current markets today, we are able to see yields as high as 6 to 15%. So assuming 25% of your asset under custody, you are able to lend out, and you, let's say 50% of that you pass on to your customers, there is still about 2 to 3% margin to be made. And again, with a $10 million assets under custody, you're looking at a $62.5 million revenue opportunity potentially. Payments is the other interesting space. And again, payments is a very broad space. When we talk about payment, that could mean a very simple POS use case, or enabling your merchants to accept stable coins or crypto as a payment, or you can enable cross-border payments. So for example, if you're a remittance company, instead of having to pre-fund in fiat, you can actually enable on-demand payments using a stable coin like USDC, for example. So again, very, very bullish on payments. And again, in terms of the fees, you can charge up to 2 to 5% basis points just for offering payments in crypto. And last but not least, tokenization. That's something we'll discuss in more detail, but there are multiple revenue streams out there. So you can become an issuer, or you can become an OTF or an MTF, where you provide a trading facility for other people to come and trade on those tokenized assets. Steven, next slide. So this, again, will not go into too much details, but basically we believe that every financial services firm and potentially even corporates can start adopting digital assets for different use cases, be it an alternative asset management. Let's say you are a hedge fund or a VC or a private equity firm, you can still offer digital assets as a service. If you are, let's say, a long only pension fund, you can offer digital assets. You can buy some Bitcoin or ETH on your balance sheet, and from a long-term standpoint, offer those gains to your customers. If you are a challenger bank or a FinTech, there are multiple things that you can enable, starting from offering a very simple buy and sell use case, or start offering loyalty points in crypto, or essentially tokenized securities or stable coins for payments. Multiple use cases which you can enable as a retail service provider. So again, we believe that every potential company, not only in the financial services space, but even outside, can start enabling or adopting digital assets. And again, over the last 6 months, we have seen some very interesting announcements come out. PayPal is launching their own stablecoin for payments. We saw Airbnb potentially offering crypto and stablecoin as payments offering. So this is not really a science experiment or a dream, but it's actually happening even as we speak. And I think the last 12 months have been very, very interesting. And just judging by what has happened over the last 12 months, over the next 12 months or 24 months, we'll see a lot of very interesting use cases evolve, and we'll see more and more companies start adopting digital assets for various different use cases. I'll just try to again, talk about the TradFi or traditional financial services segment, because I think this potentially could become one of the biggest adopters for digital assets moving forward. And again, these are the 4 broad use cases which potentially they can explore. So for example, if you are an alternative asset manager, you can start offering a simple buy and sell use case to your HNI investors or your institutional investors, where they can basically start buying and selling or investing in crypto assets through your platform. Trading and market making, again, if you are, let's say, a traditional player that is into providing liquidity, you can start offering the same services for digital assets and become a market maker or a liquidity provider for other crypto exchanges or fintechs and neobanks who want to enter this space. Tokenization, again, cannot, I know we are repeating ourselves, but that basically goes to show we are so bullish on tokenization. Again, multiple different use cases around tokenization that you can enable. And then last but not least, custody first. This is specifically true for the GCFs or the globally systemically important universal banks. We believe that the big custodians like Bank of New York Mellon, State Street, etc., will be able to leverage their expertise in offering custody services for traditional asset classes into digital assets. And I think that is something we'll see more and more large GCFs over the next 12 months jump into the space and start offering custody services and then additional value add services in digital assets. And then, of course, once CBDCs become a reality, we also believe that some of these banks or large GCFs will not only be able to offer custody services, but will also start distributing those CBDCs to the retail customers in a potentially a 2-tier structure. just talk about, again, we have talked about tokenization, but really we wanted to stress about why this is such a big deal and why we believe that, again, our thesis is for the next 5 to 10 years, every asset class out there will become tokenized. And really there are 4 or 5 big reasons, but apart from these reasons, the real underlying reason is really the shift in customer experience. So I, as a customer, now demand that I'm able to buy and sell a tokenized security 24/7, not having to depend on one broker or one exchange, but basically I can buy a security from exchange A, transfer it to my wallet, or transfer it to my friend's wallet, or transfer it to some other exchange and do it 24/7. So I think there's a massive shift in customer demand and customer experience. And now customers are demanding the experience that I get with crypto or digital assets, with securities and debt and other traditional asset classes as well. Now, from an institution standpoint, there are of course multiple reasons why tokenization is the future. Number one, of course, is the cost savings bit, right? So you are able to automate all the manual processes from an issuer standpoint. You're able to reduce costs by automating a lot of workflows. And then, of course, as Stephen mentioned earlier, reduce dependencies on the infrastructure providers like CSTs and clearinghouses and so on. And of course, given the intrinsic nature of blockchain, you're able to gain those settlement efficiencies using the blockchain. Secondly, anyone in the capital market space, you would know how tedious, cumbersome, and costly it is to enable corporate actions. Now, with smart contracts and blockchain, you are able to increase programmability of those tokens and basically enable or embed those corporate actions in a smart contract and automate the flows and make it very easy, seamless, and cost-effective from a corporate action or a distribution of coupon, for example. Number 3 is fractional ownership, which in simple words means that I, as a retail customer, don't have to invest millions of dollars in bonds, but I can actually invest as low as $5, $10 to invest in a fraction of a security or a fraction of a bond. Interesting case study, China Construction Bank about 18 months ago launched a very simple debt token issuance. And their retail customers were able to buy a fraction of that debt token or bond token for as low as $10 or $20, which in the traditional space is almost impossible. So by enabling that, what you are able to do essentially is offer more liquidity and basically give your retail customers a chance to participate in the debt or the securities markets. And then, of course, you're also, given the intrinsic nature of blockchain, you are able to offer cross-border transactions. So, for example, if I'm a private company in Indonesia and I'm looking at raising funds or going public, I can actually start issuing tokens of that and then offer those tokens to global customers across the world. So that again becomes a very interesting proposition, especially in slightly illiquid markets in the developing nations. Of course, increased security, immutability, which are again intrinsic to blockchain. Obviously, with that, you can offer those to tokenized securities, tokenized bonds, and so on. And again, from an issuer standpoint or from an organizational standpoint, there are multiple revenue opportunities out there. So you can launch new business streams such as custody and token issuance. You can launch an OTF or an MTF where people come and start trading on those tokenized assets. And then, of course, you are able to diversify into traditionally illiquid markets, like, for example, private placements or venture capital, and then, or even real estate, carbon credits, and so on. So again, these are some of the reasons why we are so bullish on tokenization. And again, I will repeat, our thesis is that over the next 5 to 10 years, most of the asset classes out there will essentially get tokenized. Again, very quickly, just to give you, we talked about the TradFi side. On the retail service and payment side, these are some of the sub-segments and the description of the various possibilities. So again, the low-hanging fruit is the crypto exchange, you can offer a very simple buy and sell use case to your customer as a non-custodial central trading hub. You can launch your own lending desk where you leverage your balance sheet, something like what BlockFi and Celsius are doing, and start offering crypto for crypto or cash for crypto as collateral. Again, a very interesting use case, which we'll see more and more over the next 5 years, especially outside of the US and Europe. Payments, we talked about multiple use cases there as well. FinTech super banks and challenger banks. I think right now what we are seeing, especially in Southeast Asia, there's almost a race to go to market first to become the Robinhood or the Revolut of those markets. And I think that again will be the story for the next 18 months, where you'll see a lot of fintechs, challenger banks, super apps offering crypto services, which could be payments or loyalty points or simple buy and sell use cases. Gaming, again, over the last 18 months has become a very, very hot sector. And I think it remains to be seen how that will it will evolve. But again, remains a very interesting use case, especially with the intersection of NFT and metaverse. And then corporates, to be honest, they have not really, apart from the treasury use case, corporates are still trying to dip their toes into this space. But I think over the next 6 to 12 months, we'll see more and more interesting case studies like what we saw with Airbnb and PayPal. We'll see more e-commerce companies and marketplaces enter the space and try to see those efficiencies and cost savings and revenue opportunities which digital assets have to offer. We'll skip this slide, but this was just to give you an idea of the immense growth that the large retail and super banks, new banks like Revolut, Robinhood have had, the impact the crypto has had on their valuation, on the revenue side. And again, just to give you a very simple example, eToro, which is a Robinhood-like fintech, the crypto fees actually accounted for 73% of the revenues last quarter, soaring from 7% last year. So that's the amount of impact offering a very simple buy and sell use case can happen on your revenue stream. Similarly, Robinhood saw 40% of its revenue come from customers trading just 3 or 4 cryptos, including Dogecoin, Bitcoin, and other cryptos. This again was up from 17%. Which was 3 months in March 2021. Again, we have talked about PayPal and other fintechs looking into this space, but this becomes a very, very interesting and hot topic. Very quickly, just wanted to talk about Revolut. Revolut, of course, is a Fireblocks client. Revolut's digital asset business is powered by Fireblocks. Revolut started on their digital assets journey in about 2018-19. They first went with a sub-custody provider, but very soon realized that they were not able to offer the best services to their customers. They came to us, asked for our help. And then over the last 18 months, they have seen massive traction in terms of adoption. Fireblocks have helped them connect with large liquidity providers and help them spin out wallets for millions of their customers. And of course, now they're getting into more interesting use cases like payments, tokenization. And again, this becomes a very interesting case study for all you fintechs and challenger banks out there. Of course, we don't have a lot of time to discuss this in more detail, but we'll be happy to, if you have any questions or you want more details for us to share on this particular case study after this session. Stephen, over to you.
Yeah. So Cigar provided a great overview of, what is the opportunity, what's the segmentation and breakdown. I think we would be remiss not to really touch what is happening from an infrastructural element or perspective as you think about engaging in digital assets. It's one of the key components I think that everyone thinks about. What is the risk of entering into digital assets and how do you mitigate that risk against the different, let's say, approaches that you can take towards digital asset custody? So I think there are 2 models that folks know or maybe have to think about. The first is this idea of self-custody, which is leveraging infrastructure to hold the digital assets or the digital assets of your customers yourself. The second being sub-custody. That's leveraging an outside party to, in effect, hold the digital assets on your behalf. And it's a model that we've seen really be reflected in the traditional asset space. Now, one of the things is really to highlight what are the key differences between a sub-custodian and traditional finance, and what's the difference between a sub-custodian and the digital asset markets. And I think it's key to think about that because there are significant risk parameter differences by virtue of these different constructs. And the first is that if you think about a sub-custodian in traditional finance, you're really having someone that provides custody services for securities and other assets, right? They're basically your access or point or intermediary to different FMIs and CSDs, and they're really outsourcing of the security of the asset and related operational components, right? There's someone to provide the back office components. There's someone to basically enable the broader access into the back office reconciliation. Now, when you think about a sub-custodian in the digital asset market, there's someone really that is securing your private key. It's someone that's required to basically hold, store, and transfer those digital assets for you. Now, there's a real interesting saying in digital assets: if it's not your key, it's not your Bitcoin. This really holds the same truth, right? If you're not the person securing the private keys, then in effect, right, other than like this broader governance layer that, or kind of, let's say, a custodial layer that sits on top of it, it's someone else controlling that assets for you. And they're typically holding those private keys, leveraging cold storage. Now, there's a ton of complexity in how you manage the safekeeping of those private keys. And what we've done at Fireblocks, or what folks are doing in the space, are really simplifying the complexity around this sub-custodial or self-custody component, right? So as you think about the differences within the traditional space, I think there was a question about how do we see this idea of centralized vertical infrastructure against what we see in the traditional markets, where there's a bit of separation and activity. I think we're going to see more and more companies start to shift towards this idea of self-custody, given the efficiencies of holding your own digital asset or your own private keys. Now, as we think about what kind of the broader benefits of direct custody are, or self-custody, I think we try to highlight them in 4 or 5 different components, right? The first is the idea of maintaining full asset control to be able to offer a top-tier experience. Now, as you can kind of tell, right, there's been a shift on the within retail and within even traditional finance of really enhancing customer experience and access, right? And so this idea of the ability for you to be able to control the asset at a 24/7 basis, to be able to withdraw assets for your customers, take deposits, move assets, have access to liquidity, be able to access new and innovative technologies like DeFi, is something that we think most companies are going to have to do or start to shift towards in 2022, 2023. Because we're seeing a large number of institutions already take hold of basically this basis from a product development perspective, and it'll become increasingly more competitive in the space. And so not having this will be a difficult stance to have. The second thing is controlling your own risk and compliance. I think, one of the things we think about is, large global custodians like BNY Mellon and large banks have the type of balance sheet that allow them to basically hold assets on their customers' behalf. As we think about what exists in the marketplace today in terms of, let's say some of the broader sub-custodians that exist in the space, they don't really have that, right? And so the ability to then manage your own risk, right? The ability to have the infrastructure to be able to hold your own keys, the ability to really have the ability to drive what type of customers you want on board, what type of automation you want to have in terms of compliance, becomes a critical differentiator in how you're able to approach the market and how you're able to launch products that in effect can reach a wide number of folks. I think the third thing is really this idea of escaping the closed loop. And that's really this idea of when you leverage a sub-custodian, in a lot of ways, you're bound by the operational processes and the risk components of that sub-custodian. So who you can connect to for liquidity, what type of venues you can have for trading, what type of external deposits you can have into the system, or withdrawals that you want to execute for your customers, what kind of new integrations do you want to have into new and open and evolving market concepts, all changed by the ability to, one, be able to control the infrastructure around the digital assets that you're holding for yourself or your customers. I think the last 2 points are really, how do you leverage your own balance sheet, right? For a lot of firms and fintechs, you guys have significant balance sheet that you might utilize to enter into the space. So how do you really minimize a lot of the counterparty and geopolitical risks that exist around digital assets within the home jurisdictions that you're regulated, right? So if you're a customer or if you're a fintech in Thailand or Philippines or Singapore, you may want to be able to hold your digital assets within that jurisdiction and not necessarily in a jurisdiction of someone that you're not regulated by, right? And so that becomes a critical factor. And we're seeing a lot more regulators push for basically the companies that they regulate to have infrastructure within their jurisdictions. And the last thing is, how do you just future-proof that business concept, right? How do you make sure that you're using the latest and greatest technology? How do you ensure that basically you're able to custody things like stable coins and other tokenized assets? And how do you enable that in a very critical function? And so really these components that we've kind of highlighted, these 5 components, are why we're seeing a bigger shift towards this direct custody model over what was the sub-custodial model that was typically in the market. Now, what we try to highlight for you at a high level is, maybe where you can see some breakdowns between this idea of self-custody versus sub-custody. And we've highlighted them on the idea of things like balance sheet, whether or not you have a small or large balance sheet, the type of flexibility that's required to connect to other components within the ecosystem, whether or not you need things like tokenization if you're going to do some primary issuance or issue your own stablecoin. What kind of compliance automation would you like to have, right? So if you're a retail customer or you have, let's say very strong compliance needs and want high levels of automation, how do you implement that and whether or not that's needed for you? And then the type of trading strategies and regulatory constraints that you might have, right? And basically we're able to kind of say, if you're typically a long-only fund or a family office, you may look at a sub-custodial model. But if you're a bank or a fintech or a crypto native firm, right, that's launching new products and services, interacting with a variety of customers or different use cases of your clients, you would probably want to move towards a more self-custodial model. Now, in the last minute or so, what we'll do is we'll go through the go-to-market approach that we see a lot of folks taking today. And Sagar will take you through that, and then we'll answer any questions that have come up during the chat.
Thanks, Stephen. So yeah, at Fireblocks, we are obviously a custody infrastructure provider, but we see ourselves also more than just a tech provider, but a trusted advisor to your growth, and which is why we work with a lot of enterprises and financial services institutions, helping them with their digital asset strategy. So a lot of companies and corporates and institutions come to us asking for our help. Where do we start this? We are very interested in digital assets. We see a lot of potential here, but where do we start? So this again is a very rough roadmap or a GTM strategy in terms of setup or day one setup on how you can go about launching a successful digital assets business. So number one advice that we can give is to involve your compliance and legal folks as early as possible in your journey. Understand the regulatory landscape, understand the licensing regime. So for example, if you are a corporate setup in Singapore and you want to start offering buying and selling of crypto services, the first thing that you may want to do is consider applying for the DPT license or the digital payments token license. But that becomes very important, setting up the compliance framework and involving your legal and compliance folks right in the early days of the journey. Some people, I think, push that to the back burner, but we believe that should really be the first step. A thorough analysis of the compliance and legal landscape in the country. Then you need to decide about, again, very importantly, the use case and the products that you're going to offer. What is it that you want to offer? Where is it that you see most potential from a revenue standpoint? So again, lay out your go-to-market strategy. And again, we believe that the foundation layer will be custody, and then you start building on top of the custody layer. Then you start thinking around the key personnel. Of course, if you're launching a new business, you'll have to think about setting up a board, the C-level execs, but again, more importantly, a very important chief compliance officer. And again, if you're applying for a DPT, that's almost a mandate because the MAS will interview your chief compliance officer to understand more about your compliance frameworks. Then, of course, you can look into hiring head of operations, head of sales, and so on. Then, of course, you look at your target segments, your geographies, and again, becomes very important to understand the regulatory landscape of those countries and understand what is the best solution you can offer and what is the best compliance framework you need to set up. And then, of course, in parallel, you need to set up the core tech infrastructure, again, with custody as the base layer, setting up your AML KYT framework, frameworks, and then of course connecting into other liquidity providers and market makers. So that essentially is a very rough map of what your day one setup will look like and how you need to start thinking about in terms of planning. And again, one thing that we would like to add is that a lot of people who are not from the crypto space and who are just entering this space think that it's very complicated, but actually you need to break it down and it actually becomes very simple. So I'll give you a very small example. So if you are, let's say, a super app or a fintech that wants to launch or that want to enable their customers to buy and sell using your app, you need not launch your own order book. Of course you can, but you need not on day one. All you need to do is connect with a liquidity provider or a market maker, use their liquidity, and then add your spread and offer the code to your customer. So that looks like an agency trading or a brokerage model, as opposed to launching your own order book on day one. So these are some of the tweaks that you can look into, and it becomes actually very simple once you start breaking it down. And of course, we at Fireblocks would love to be your trusted advisors, and we can help you with your journey as you go deeper into this.
All right. Thank you, Sergey and Stephen, on your sharing. Just do a quick summary, I guess, on the types of crypto, digital assets, the business models you can adopt, key considerations before you get started with it. And actually how crypto and digital asset custody differs, from the traditional assets, and why it's important to ensure that it is not only scalable but secure while exploring such solutions as well. Now, also meeting the needs to be able to create wallets quickly, securely, and without incurring high gas or transaction fees. And of course, lastly, an overview of the types of digital asset custody solutions that are available today and how they differ as well. So I do have a couple of questions coming in from the audience. For both, Stephen and Sergey. Let's start with the first one. How do you see regulations shape the industry in 2022? And do you think it will lead to more adoption, especially among the traditional financial institutions, or they will act as barriers to innovation?
So, yeah, I'll take a first stab at that. So I think I mentioned it earlier. I think there is increasingly more clarity, right, around digital assets. I think it's become big enough, or too big for folks to be able to ignore. I think there are certain jurisdictions that are leading the way, right? Again, I mentioned them earlier as FINMA and BaFin and MAS here in the APAC region, where they've been able to lay out, I think, clear guidelines in terms of engaging with digital assets. There's, certain hiccups here and there around kind of things from advertising to other things. But in general, right, there's been clarity around who can engage, what's the process for getting the license, what's the process for engaging, and what constraints exist, right? And I think, certain jurisdictions like, Germany and BaFin, even in FINMA, and what they've done in terms of, getting rid of the idea of a central securities depository for tokenized assets, right? And having this crypto register, right, where any custodian is able to tokenize an asset and distribute it, I think have done things to kind of push the space forward, right? So I think people are watching that. Other regulators are watching that. I think there was a conversation with folks around, do other regulators talk to each other? And it's very clear that they do, right? And so I think folks don't want to be left behind in this concept. And I think banks and traditional institutions are looking for clarity for that. And so they're starting to provide it. So I think that's going to be a big push in 2022. I think it's going to give a lot of folks a lot of leeway to get into this market in areas like tokenized securities, as well as like basic digital asset custody at a large scale, and offer that to their customers directly.
Right, thanks, Stephen. So the next one is, apart from the technology aspect, what are the other key points that the audience should be noting or keep in mind when launching a new digital asset business?
Yeah, so I think we touched upon it very briefly, but really, as I said earlier, compliance and legal analysis of the regulatory landscape and the regulations becomes extremely important. So one should involve the compliance and legal teams as early as possible. Then you need to understand start involving your business teams and understand what are the use cases and products and services that you will be offering on day one. Again, and everything starts evolving around that. So I just saw actually a question in the chat room where I think someone asked, or Adam asked, if you are a small custody provider, what kind of a team size do you think is necessary? And again, it depends on the use case. What is the use case you're going to enable? Are you only going to provide custody services, or are you going to provide custody in combination with, let's say, issuing tokens, or custody in combination with brokerage solution, or potentially custody in combination with payments? So it all depends on so again, very important to understand the use case and products that you're going to launch. And then third, and then last but not least, from a security standpoint, partner with the right custody tech provider or a sub-custodian if you are going that route. But security obviously is extremely important here, which is why we believe that no matter what you do in this space, custody always will remain the foundation layer. So it's very important to get that right, both from a tech standpoint, operational standpoint, and a compliance standpoint.
Right, thanks.
One quick note there, right? I'll just give a practical example. We have clients, or clients that have millions of wallets, right, and extremely small operational teams. Why? Because they're able to execute a lot of processes and workflows with high levels of automation and the right governance structures on top, right? So the system is able to trigger, what kind of stoppages and starts should happen in the system, who can sign certain transactions, what type of transactions can be highly automated versus what type of transactions require manual intervention. And they can link that into the right KYT and AML providers like Chainalysis and Elliptic to be able to then make sure that basically what was a highly manual process of compliance reviews becomes a highly automated process of pinging Chainalysis or Elliptic, getting a risk score back, feeding that back into the system, and then either approving or rejecting a transaction, right? You, in essence, kind of shave off the number of operational personnel that are needed to basically, in effect, handle a pretty significant throughput of transactions. So there's a lot of things that Sagar was mentioning that can be done to kind of minimize the number of people or kind of the number of, let's say, manual processes and interventions that you typically would see on day one within this marketplace.
Right, thanks, Stephen. So probably we've got enough time just for two more questions here. On security, what's so great about the MPC that Fireblocks is promoting as compared to multi-sig, and why do you think this will become a industry practice for custody technology in the future?
Look, I would say you've seen the broader market move towards multi-party computation, right? You have Taurus, you have Coinbase, you have Gemini's acquisition of ShardX, you have Copper. I mean, I think there's a big push. You have Coinbase's acquisition of Unbound towards multi-party computation, right? And the idea being that you're reducing this concept of a single point of compromise and a highly secure system, right? And this concept that the private key comes together to sign the transaction, which in multi-party computation, that does not occur. Now, with anything, right, reducing, and if you think about blockchain, it is a cybersecurity issue, right? So reducing what is a big cybersecurity risk of this single point of compromise is something that I'd say most of the market is doing as the market cap of digital assets grows, right? Everyone is now holding on to billions and billions of dollars of assets, reducing this idea that basically you can come into the system, you can see the number of signers on a particular wallet, you understand there's a single point of compromise, is something that shouldn't be the case. So I think you'll see more and more firms move towards multi-party computation. I think you'll see an evolving of protocols that basically secure blockchain assets. And you need to make sure that you're working with the right firm that's paying attention to these developments and is basically implementing those in real time to make sure that you have access to the latest security around your digital asset infrastructure.
Right, thanks, Steve. The last question here is, do you think that the current full stack crypto exchange architecture will evolve into a more traditional kind of TradFi-like structure where clearing and custody will be segregated from the trading platform?
Yeah, I do actually. I think very simply, this idea of prefunding on centralized exchanges is something that will not happen moving forward into 2022 to 2023. If you think about large traditional institutions, they are not used to this idea of pre-funding on a centralized venue, taking counterparty risk to that venue, settling, clearing, and then settling on that venue, right? And so we're actually starting to see a lot of FMIs start to look at the digital asset space, right, and how they can step in and provide, clearing and settlement for digital assets, with distributed assets being held by, their clearing members and other parties, right? And I think that's going to require a lot of digital asset or crypto native exchanges to adapt and adjust the models that they're used to. I think it'll probably hold steady for retail, right? I don't anticipate centralized exchanges getting rid of pre-funding on the retail leg. But if they do want wider spread, institutional adoption, asset managers, hedge funds, they're going to have to shift, right? And we're going to see more models where, basically the exchange, the clearing, and the settlement become differentiative factors across that value chain.
All right, thanks, Stephen. I really like the enthusiasm of the participants. There's still a lot of questions streaming in, but I'm afraid that it's not all the time we have for Q&A. Now, your questions are really important to us, so if you're unable to answer them today during the webinar, we will respond to them, via email that you provided, and we'll get in touch with you very soon as well. Now, the webinar session will also be available on demand after the live session, so if you'd like to visit, it's available. Also, I'd like to request that you help us complete a simple survey at the end of the webinar to help us better engage you moving forth. And we'll be conducting more, webinars ahead in 2022. So covering focused subject matters in relation to crypto and digital assets. So please do look out for our next webinar. So thank you for taking time to join the webinar, and look forward to having you again during the next webinar. All right, over to you, MJ.
All right, great. Thank you so much, Matthew, Stephen, and Saga. And we also appreciate everyone being here. As mentioned, there will be a survey pop up towards the end. It would be great if you could share your feedback on the webinar with us. Also, this is a 3-part series of Fireblocks, so you can look forward to seeing them more often towards the year. If you're interested in more of such events, do keep a lookout for our weekly newsletter that has our upcoming events listed. Thanks again for joining us for the first webinar of 2022, and we look forward to seeing you again. Thanks, everyone.
Thank you.
Thank you.